All right, welcome back to another Bootstrapper Live. Today we have with us the Gelt team. We have Tal, Rachel, Spencer, and this is going to be an awesome episode for you to be able to be a part of, experience, and hopefully work at home. So take out your pen and paper, follow along if you are working in a pass-through entity and you want to reduce your tax bill. This is the opportunity to learn the ways before the year end that you can actually do so. This is going to be all of the sauce, and we're going to let it flow. And before we jump into a quick disclaimer, none of this is personal tax advice that we're going to be covering today. I'm sure there's going to be maybe a couple of other asterisk on the conversation, but there is going to be a lot of valuable information that we're going to dive deep into. Kicking it off, team, I appreciate everybody joining us today for this Bootstrapper Live. There's going to be folks at home that are listening. They're hopefully going to be following along. And the job to be done is by the end of this webinar to hopefully give them a plan in place that they could maybe reduce a little bit of that tax bill at year end coming up soon. Where should we kick off?
Thank you for having us, Chris. It's great to be here again. I think that the first one is really, maybe, before we jump into everything, is just to understand why now, why it's a good time to think about it. Like right now, we're on November 18th. Like at Q4, like Q4 is when all the financials are kind of coming together and you know exactly where you're going to land, what will be your annual numbers. It's much more clear at this point of time. So now we can look at those numbers and take a step back and see what we can do retroactively during the year, from the beginning of the year, but during the year. That's why now it's a really great time. And I think that, Rachel, what's the first thing that we're going to talk about?
Yeah, the first thing that we're going to talk about is vehicles. And I think to give it a little bit of context, as you're getting to the end of the year, like Tal mentioned, your financials are really kind of starting to take shape. And so that's where you can see, is this a really good year? Is this not such a great year? And really understand where you're going to be at and what things you can do to reduce your tax bill or optimize the tax that you're paying. So buying a vehicle, and in particular, a heavy vehicle, is a particularly nice one where you can potentially get more of a deduction and more tax savings than you could even be laying out in cash at the end of the year. So a little bit of background: if you have a business and you use your vehicle for business, you're able to deduct expenses for the business use of your vehicle. And those expenses are, your gas, insurance, etc. And then if you own the vehicle, you also get something called depreciation, where you're taking part of the cost of the vehicle over time as a deduction. So usually there's special rules with vehicles in the IRS. And for depreciation, you can take about $20,000 the first year, and then the rest will spread over time. But there's a special rule with heavy vehicles, specifically if they're over 6,000 pounds of, it's called gross vehicle weight rating. So if they have a GVWR of over 6,000 pounds, then they're not subject to those typical IRS limitations. And you can actually take 100% bonus depreciation on that vehicle as long as it's placed in service during the year. So hypothetically, if you used to purchase the vehicle on December 30th, you use it 100% for business, you financed it, you put $3,000 down, and that's an $80,000 vehicle, you could potentially get an $80,000 deduction right at the end of the year. So it's a really good opportunity. Like if you have those really big years and you're scratching for like, what can I do? If you want to buy a vehicle, if you're interested in a heavy vehicle, it's a really cool way to get a nice deduction.
Rachel, couple questions there for folks at home that are bootstrapping and they may need to buy a car, right? I see at the beginning of every year in January, all my bootstrapper friends just driving around in their G-Wagons. Is that why when we're talking about these heavy vehicles, that's what we're talking about? It's 100% forced depreciation for something that's over 6,000 pounds, which I think like there's only a handful of actual cars that qualify for that. But what about something else? Like, does that also qualify for like a box truck, for example? I'm trying to think of all the things in my brain that I could go out and buy.
Yeah, so a lot of vehicles are, it's different than the curb weight. The curb weight is usually what's going to be on the sticker, and the GVWR is different. There are some websites that'll list out all the vehicles that qualify, and there are quite a lot. So even some larger SUVs will qualify, and what it and so you'll be able, that enables you to get the 100% instead of just being limited to say 20,000 in year one. So if it's heavy and it's more expensive, those are ways that you can really optimize the deduction.
Like a couple of example, we have like Lexus GX, I think it's one of them. Like Tesla X is another one of those. There are plenty of examples, but there are quite a few. It's not a handful. That's the thing. I think like we can do quite a lot.
It's like a
Yeah,
market
it's
to be made. Like there's a problem, there's a supply demand problem to be solved within that. Like that's onto itself a little micro market, which is super interesting. And when we say that we can purchase these vehicles, these are not purchasing vehicles for our families, right? These are vehicles that we have to ultimately use for the function of our business. What's the qualifications there? Is that like a real
yeah,
estate agent?
yeah, they have to be used for business. So if you're going to see clients, if you're hauling goods around, depending what your business is, it needs to be have a business purpose. You can have personal use, so it doesn't need to be 100% business, but the percentage that you're using the vehicle for business is going to directly relate to how much you can take as a deduction. So if you're using it 80% of the time for business, you can't deduct 100% of the cost, but you could deduct 80% of the cost. So in order to, like, a common question we get is like, how do do I have to track all of my miles to get the business deduction, to get that business use percent? And you don't have to. That's what the IRS would like you to do. But they're also, reasonable, and that's not always something that's reasonable to do. So what you can do is, if you track your mileage for, let's say, 2 weeks in a row, regular, like your regular business use, and you're tracking those miles, and you do that maybe once a quarter, you can use that information to apply your business use percentage for the entire year. And so if those periods were about 75% and you drove 10,000 miles for the year, then you would have 7,500 business miles, or 75% business use.
I'm loving this. So it's like it's year end. We're closing out our books. Yes, that's one thing to be done, a job to be done, but it's also the holiday season, and we're getting in the mindset of spending. And one of the things that we could spend our money on is this vehicle. Since we're in this mindset of spending and we're trying to reduce our tax exposure, is there anything else? Like, so when we're thinking about the business and we're thinking about other things that we could potentially purchase, what else could potentially fall into place?
Yeah, I can
Yeah.
take this one, Chris. So, in the spirit of spending during the holiday season, you could think about some things that your business is going to spend money on anyways. Maybe you buy it in, January, February, June of 2026. But if you've had a good year in business, your revenue and your profit is looking high, which means your taxable income is going to be high, which means your tax bill is unfortunately going to be high. You might want to bring some of those expenses into the current year, so into 2025. So if you're going to spend money on it anyways, and you have the opportunity to pay for it ahead of time, you can prepay software. You could prepay some professional services, will allow you to pay them ahead of time as well. You could bring those expenses into December 2025. You file your taxes on the cash basis, so the cash has left your business. It's an expense, reduces your taxable income.
Spencer, so for folks listening at home, just to think this through. So we had a great year. It's not quite New Year's, but we have some champagne problems. We got a really healthy P&L, and we need to put that profit to work. What we're really thinking, and what you're saying, is think out in the future, right? We're living in the now, but really think about next year, and think about maybe something that you'd be investing money into in July. And you know that this is an expense that you may incur. If it's going to happen and there's a good timely decision to be made, maybe the time to make the decision is right now. And if we do make it right now, we can actually apply it towards this year closeout and reduce what our exposure is.
Yeah, think about it like you're investing in the future of your business, the growth of your business. I've seen clients prepay for marketing, some marketing spend that they can pay for in December for online ads or something like that. And we talk to clients from time to time that unfortunately think that if they're leaving money in the business, meaning they're not moving it from the business bank account to their personal bank account, that that is them investing in the business, and therefore they do not have to pay tax on that. But that's not true. You pay tax on a financial statement, your profit and loss. So if you're showing profit, it doesn't matter whether you leave it in the business bank account. The IRS says that's your money. You made it as income. You're going to pay tax on it. So unfortunately, you do have to spend that money before 12/31 if you want to get that expense credit. So invest in your business by actually spending on things that matter. Don't needlessly spend, of course. We don't want to spend $1 to save 30 cents on your taxes. But if you're going to spend it anyways, think about accelerating it.
Yeah, think about it as an investment. I feel like there's definitely a little cough, 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 asterisk, asterisk, asterisk for some folks listening there too, in terms of some tidbits. But if we were to focus on this, it's better to essentially pay it forward and invest in the business rather than potentially have to give it to Uncle Sam, and you're having to allocate that capital regardless. Small, probably, little hint. I know that we've done it in the past with some of the companies in our portfolio. You have SaaS, right? SaaS oftentimes has a recurring billing, and oftentimes those contracts come up year of end. And a lot of times those motivated sales reps and account executives want to get those sweet, sweet, sweet renewals in. Fantastic time to leverage some timing and negotiate next year and buy in full and get a really great discount in terms of that AE wanting to hit quota. So it's an opportunity to potentially leverage some time as well. What about the concept of an office and a place to work? So I'm thinking about.
1 second before we jump office, it's also another thing, but there is actually a connection between the first point and the second point, like cars. One of the games that people are basically paying when it comes to the car for the business, they're buying cars at the end of the year, let's say, let's say that the car costs $100,000. Instead of paying $100,000 in cash, they're basically paying a down payment, let's say, of $10,000 and take $90,000 loan for the car. Because of the depreciation, they get to take 100%, $100,000 as a deduction in the first year, but they actually paid only $10,000. So you put $10,000 down payment, you take $100,000 of asset, you completely deduct the $100,000 the same year, and then you pay the remainder of the $90,000 over the next 5 years, let's say. Even the interest that you're paying for the $90,000 is deductible on the business, as it's a business expense.
So if there even is interest on a car note.
Yeah. If there is any, but even if there is anything,
and maybe deduct it off of your expenses there.
Absolutely.
So that's almost like a little bit of a lever of alchemy to a certain extent. So like just listening to what I heard, it's make sure I'm picking up what you're putting down. So you're taking 10K of cash, and you're essentially leveraging that 10K of cash against 90K on a note. And that's something that you could play out over 5 years to pay back. And the interest you pay back over 5 years, you can also expense over 5 years or write down over 5 years. But meanwhile, you just acquired 100K liability.
Deduction.
That is a deduction that you could get to 100% to on the year. So you just got
it.
100K for 10.
Oh, yeah. So if your tax rate is like 30%, let's say, you get $30,000 back on $10,000 that you put in.
What else can you do that with?
Well, any asset. Honestly, like if you're a physician and you need a new, like let's say that you're a dentist and you need a new chair. Those chairs are quite expensive. You can do the same thing. It's a little bit different, but the concept is kind of like repeated itself across multiple options across that.
The only thing you want to be careful about there is you want to make sure that you are buying it and not leasing it or doing any kind of equipment rental. Because if you are leasing something that's considered a rental and you're not going to get the depreciation. So it's really important that when you're doing this, that you're actually purchasing the vehicle, equipment, whatever it might be. And then just to also touch on the, like, if you can get a discount for prepaying things. A lot of times when you're accelerating your expenses and prepaying things, just want to call out that that's a timing difference. So you're still gonna, if you're paying something in advance, then you're gonna pay less tax now, but that might mean that you'll pay more tax next year. So there are certain things that we can do that are going to be kind of changing the timing of when we pay tax. And it's usually better to pay less now, but then also there's actual tax savings, which is where if you're getting a discount by prepaying, then you're actually paying less and you're getting a tax savings overall.
Yeah, no, this is the type of thing that folks don't typically talk. Like, this is definitely not dinner table conversation of most bootstrapped entrepreneurs, but it's the type of conversation that matters because there's so many little nuances that you can get into, and it makes you also think. And that's what I've been doing while we're going through this. I'm kind of like inventorying through the business all these different ways in which you expend money, and then I'm trying to think about it and like tie it to is potentially that's a way to save money on taxes. And that's what I was thinking about in terms of big purchases and big places and the office, right? Oftentimes where folks work, right? So vehicles we drive, huge. Software we use, huge. Office space, I feel like, is a huge expense. Is there anything that could tie to that?
Which one? Who wants to take it?
You could theoretically prepay your rent, for the year if you had the cash flow and you wanted to do that. But to Rachel's point, then that rent expense is not going to show up in 2026.
I think that maybe what Chris is trying to lead us towards
What if I work
is
at
home office deduction.
Uh-huh.
Yeah, I think home office deduction, Augusta. I think that's the kind of stuff that he wants us to talk a little bit about.
And I only knew to ask because of Tal, episode 13 of Bootstrapping the Billions. You already gave a little bit of a hint to me. And I knew that when we were going to get back on, I definitely wanted to be able to plug it in some way, shape, or form. Because a lot of bootstrappers, a lot of folks that are living in the space, listening to this webinar right now, they're thinking like, all right, I work from home. Like, what can I do?
So when it comes to the home, like where you actually live, your personal space, there are two ways basically to account for that expense. One is through home office deduction, and the other one is through Augusta rule. Home office deduction, the rules, like Rachel Spencer can talk about that, and Augusta rule is, I'm sure a lot of people heard about that you can rent your own house to your own business or to anybody for up to 14 days a year. Take the deduction, basically take the expense from the business, but you don't have to fully report the 14 days of rental as income. It's like a little bit of like walking on a very like between the Augusta rule and the home office deduction, there are different requirements for each one of them. For example, Augusta rule require you to own your home, and home office deduction does not require you to own your home. And in many cases, you need to pick one or the other depending on the circumstances, which one you want to take, and not both of them at the same time. Again, depending on the circumstances. But those are kind of like the two ways. And Rachel, you want to explain more about home office deduction?
Yeah. So your home office, I think we're all in a home office right now. But home office is anywhere where you're doing business exclusively from your home. So it could be a dedicated room. Even if you do have an office for your business and you have a dedicated area that's used for storage, that could be considered a home office space. Or it's also the area that you're exclusively doing business. So if you only do your admin work from your home office, then that also can be considered a home office. And when you're taking that home office deduction, same thing as with the vehicle. You can't deduct your entire cost of your home, but the portion of your home that's used for business purposes, you can deduct. So if you own your home, that could be part of your rent. If you own your home, part of your mortgage interest. If you rent your home, part of your rent, insurance, maintenance, cleaning, all of those things, a portion of what you're spending can be treated as a business deduction. Now, same thing with the vehicles. You have a couple of different ways that you can calculate how much is my home office deduction? What is that business use percentage? And again, the IRS will want you to go in with your tape measure and measure the square footage of the designated space that you have, compare that to the square footage of your entire home. And usually that ends up being a relatively small percentage. But there are other options available. Again, when you get into it, the IRS is pretty reasonable. They just want, everyone to pay their fair share. So what you can do is you can use your living areas and count the number of living areas. So for example, right now, I'm in a dedicated room that this is my office. My house has 3 bedrooms. So I would say I have about 6 living areas. So I have 3 bedrooms, kitchen, a living room, and a dining room. So instead of doing the square foot, I can say 1/6 of my home is the home office. And usually that'll end up being a better outcome than if I were to just measure the square footage of this room itself.
There is another way, by the way, to calculate, but we will not dignify that answer in this podcast.
Oh, yeah, no.
It's complete BS and nobody almost needs to use it. But there are basically 3 ways. But the last one we should not talk about until
there are some cases where that one actually is the best. But
I know,
it's so rare.
I know.
It's so
The way
rare.
that
It's
shall
so
not
rare.
be named.
No, it's an edge case. It's a complete edge case. No reason to talk about it. Maybe after the podcast, if you're very interested, we can talk about that.
when we're talking about it, so I missed it earlier. I apologize. Is it either or? So is it Augusta room rule or is it both? Can you do both? And which one typically benefits you the most? And does it determine whether you own versus rent? Like
Those
if you were to
are
break it
really-
down by type.
Those are really, really great question and so personalized. I'll give you an example. And it really depends on your circumstances. For example, if let's say that you're not, but let's say that you're living in the Bay Area. You lived in New York and you moved to Florida, let's say. In New York, you rented your apartment. So for your rental, it's home office deduction. It might make more sense. You cannot take the Augusta rule because you do not own it. Yeah, you don't own it. You cannot take the Augusta rule there. So let's say that there you took the home office deduction. However, after you moved, when you came to Florida, you said, "Hey, I'm going to live in Florida my whole life. Zero state taxes." By the way, I highly recommend it. Great state, but not sponsored. But then you buy a house in Boca, let's say, and in Boca you actually bought the house and you own it right now. Now you can use the Augusta rule. So theoretically speaking, you can do both in a single year, and it really depends where you live, what makes more sense to you, and your mortgage interest rate, and how much you're paying for mortgage. Are you married? Are you filing as single? Like, it really depends on all of those, because if you're taking, for example, some of your mortgage interest on the business as an expense, you cannot take it on the personal side under your itemized deduction. So suddenly it becomes so personalized that there is no kind of like one rule, hey, you should do this or you should do that. It really depends where you live. Do you own your home? You don't own your home? What's your mortgage rate? What happened to you throughout the year? And do you have maybe multiple places that you live?
So
then it becomes more complicated.
It definitely falls inside that disclaimer at the beginning of the webinar here of this is not individual tax advice, without a doubt. Okay, fair enough. We're starting to rank and retrieve. So we just already covered 3 different strategies to be able to reduce the tax bill. In my mind, I'm slowly starting to rank and retrieve like the best to the worst. I'm hoping that towards the end of this, we could definitely maybe do a full review to be able to for the folks at home. But what other things? So I know we've been talking about things that we can invest money in or spend money on to get to the reduction. Is there anything in terms of like saving?
I think that's a good time to talk about like maybe a potential S corp election or entity structure overall and QBI. Who wants to take that? Rachel, myself, Spencer.
I could start, and then we could pass it around. Um,
Sounds good.
I can just kind of touch on the basics of an S corp in case there's some people in the audience wondering. So an S corp is a tax election for your entity. So probably most of the bootstrappers listening are LLCs. That's their entity type, and you can elect for your LLC to be taxed as an S corporation. The benefit of that and the savings that Chris's question, kind of hinted at us to talk about the S corp is when you are a business owner, you are self-employed, and you pay what are called the self-employment tax, which is Social Security and Medicare. When you start as an LLC, by default, you are a single member, disregarded LLC in the eyes of the IRS. You've probably seen it on your tax return. It gets reported on a Schedule C on your personal tax return. And it's only 2 or 3 pages long to report your business activity. A way to help you save on those self-employment taxes, the Social Security and Medicare, is to elect S Corp status for your business. What happens when you're self-employed? You are the employee and the employer. So before you hit that Social Security wage limit, you're paying 15.3% total for Social Security plus the Medicare. When you become an S Corp, you do have to pay yourself a reasonable W-2 salary. There's no necessary black and white definition as to what reasonable means. So you should work with your CPA to help you determine what you should pay yourself. On your W-2, you do still continue to pay the full Social Security and Medicare, but any profit above and beyond the W-2, you pay 0% of that. So when we're working with clients and we see people who have grown their businesses to 6 figures, at least we want to see of profit, we're going to take some of that profit and pay it out as a W-2, and then the remaining profit you save on that 15.3%, depending on where you fall in the Social Security range.
Is that so? That's the threshold then. So it's 100K or more realistically when this becomes a relevant conversation. Because I hear this get thrown around all the time. I feel like a lot of bootstrappers listening at home, this is almost like table talk advice of like, oh, you should convert to an S corp. Like you're going to save so much money. Like when does that actually? So it becomes relevant when it becomes relevant at 6 figures, and who does it become relevant for, and when does it not become relevant? Because I feel like this is like something folks really do need some tidbits on.
Tal's got a hot take, I think.
Yeah. I just posted a couple of days ago on LinkedIn and a hot take that S corps is really not for everybody. I think that like there is not a single number. It really depends on your circumstances. It depends on your retirement goals. It depends on your QBI because there are like some limitations the moment that you are getting into an S corp, that limitations of how much you can contribute into retirement that can limit the Social Security and Medicare options there. It really depends on the type of business, but generally speaking, I think that people who are making less than $130,000 a year of income in general, like S corp is probably, and again, it's super personalized, is probably not the best thing that they can do. And sometimes, we had occasions that like basically people were mad at us for telling them, hey, you don't need to complicate yourself with an S corp because the tax benefit is just like to save $1,000 and invest 10, 15 more hours a year or even more, just like to have $1,000 difference on your taxes. We think it doesn't make sense. It's too much headache for too little savings. So it needs to really make sense on like money wise in order to make it. And I would say like $130,000 of revenue, not net income, not profit, like revenue. That kind of like when you start to kind of like question and think, okay, most likely it might make sense. But I think that like the other thing that maybe Spencer insinuated before, whether like there is the Social Security portion for the S corp, but there are 2 other elements that when you're electing to be an S corp, it's really important to optimize for. Number one is retirement. how much you can contribute to retirement the moment that you become an S corp changes. So depending on your stage in life, on your total income, and what you want to do and how you want to manage and invest your money, retirement contributions can be really, really beneficial. Usually S corp owners are taking either the SEP IRA or the solo 401k. Each one of those, it's a whole conversation by itself. And the S corp limits how much you can contribute to each one of those. So when you're making the S corp election, like, you want to take that into account as well. And the second thing is something called QBI. It's section 199A. It's also a complicated one, but the long story short, you can take either 20% of your net income or 50% of your W-2 payments in the company, the lower between the two, as a deduction. And that's called the qualified business income deduction. And the combination of the QBI and the S corp election and retirement, all of those together really varies depending on personal situation. So S corp election, not as simple as it sounds, and that's the least, by the way, practical advice we can give people, which is not a personal tax advice again. But yeah, again, exactly. Disclaimer. But I think that S corp election, especially when you're making between, I would say, around the 130 plus minus $20,000. It really depends on what you want to do with your money before you make that election. But I think the coolest thing about S corps is that you can make that decision retroactively. So you are in Q4 right now, you know your numbers, you know where it's going to land. You still have about like a month and a half before some doors are closed. But with S corp elections, in certain circumstances, you can retroactively elect to be an S corp since the beginning of the year. Theoretically, you can elect to be an S corp retroactively 3 years in advance, but in very specific cases. But let's take the most common case. You get to November, right now in November, you're looking, okay, the numbers are looking really, really good. It's no longer kind of like a side hustle. It's something that is actually business. It's making good money. You can make the S election since January 1st, 2025, retroactively, and not to commit to it in the beginning of the year. And it's something that I think we quite often suggest people. Let's look at the numbers in Q4. Let's make the election when we are quite certain that it's the most beneficial thing for you, and not make the election ahead of time, because revoking the election, it's not that simple. Let's see the numbers. Right now, we have a good sense where you're going to land. By the way, if you're taking the $100,000 of the Tesla X that you just bought, it might completely change our idea whether we should.
With only 10K down.
Exactly. So let's take that example. Imagine you made like $160,000 in profit so far this year. Great year. Let's say.
I love how you keep going 130. 150. Now we're at 160.
No, it's just an example. Let's take the 130. Let's take the 130. Let's take 130. You made 130, and we said, okay, generally speaking, might be good to make an ad selection. But you say, oh, I really need a car for the business because I need to drive around, meet clients and do business with people, whatever. You are doing the $10,000 down for $100,000. You did the whole thing. Now you have $100,000 of deduction. Now your net income is not 130, it's just 30. Making an S selection on $30,000 will probably cost you more than what the benefit would create for you. So that's an example how combination of different strategies and different things that you're doing might affect your decisions of other, and there is dependency between them. And that's why it's so important to have a very personalized plan around those. It's really need to be tailored to your personal situation, how much money you make, what you want to do with your money this year, what you want to do it next year, because we want to look forward. Hey, what do you plan to happen in 2026, maybe 2027? Just general guesstimation, what can happen. And then based on the likelihood of that happening, we can create a plan. But strategies collide. they don't always play well with each other. So it's really important not to really hit every single strategy that you can find. It's really important to choose the right combination that will result in you putting the minimum amount of effort and cost for the maximum tax impact you can find.
Mm-hmm.
I'm not taking every single deduction myself because I don't want to invest that much time of my time for a couple more dollars. I'm taking the ones that are the minimum effort, maximum impact. And it's a very personalized decision. Some people don't want that. I personally do want that. But I think that's one thing that is really important for people to
there's a
know.
lot there, and I think a great place to start and circle back is where you began, which is a contrarian take. And I've come to appreciate that from your content. I enjoy your content. I told you that on the pod, and I feel like oftentimes the contrarian take is a very real take to take into consideration, because you need to see both sides and you need to see all sides and you need to challenge. And I feel like that's something that the Gelt team does very, very well. And it's like, make good, timely decisions, right? But you got to make decisions, and they hopefully are good. But when folks come involved, so anybody listening to the webinar right now, they're in this conversation. They're like, man, you're literally speaking to me. Maybe I have a side hustle. I'm getting to the point where I've been bootstrapping and I'm getting close to that 150, 160. I've passed 130. Maybe this is something I should take into consideration. Man, there's a lot of things going on here. Like, let me actually think about this. Let me actually maybe take some action on this. If they were to take action and they came to the site, joingelt.com, and they went through the process, you guys, if I recollect to episode 13, you take a very intentional approach with everybody, right? So this is one of the functional things in which they would get to experience. And it really is on an individualized basis, right? So you're really taking all accounts, you're taking everything into account, and then you're creating a plan and a strategy that makes sense for folks in their circumstances. And it's not oftentimes everything. It's ideally the right things.
Yeah, well, definitely, Chris. And as the account executive, I talk to a lot of people who are interested in joining Gelt. And the way that I like to run that initial discovery call with clients is very consultative. So I want to understand what's going on in this person's life and business. And then I will give them, kind of my 2 cents on what I see as opportunities for further optimization of their taxes, or I will just straight up tell them that an S corp is probably not the right fit, and something that would trigger a flag in my mind. You mentioned side hustle, right? Well, when I think of side hustle, it makes me think that they probably have another job, and if they have another high earning job where they're taking a large W-2, well, it's possible they've already hit the Social Security limit through their W-2 job. They will get zero Social Security benefit by electing S Corp. So just another reason where it's not always so black and white. And we do try to take a personal approach. And, we want clients to enjoy taxes as much as possible. So we don't want them to spend a bunch of time and headache if it's just going to save them $1,000. And I do think Gelt also does a good job of, we don't recommend entities and entity structures to juice up our engagement fees, right? If it's not going to be a good outcome for the client.
Yeah, it's a super pragmatic approach. I've come to appreciate that a ton. And yeah, some folks, I mean, everyone's at a different moment in time, right? Whether you're exit one and you're trying to exit your day job and make your business your job, or you're moving and maturing towards exit 5, let me get ready to exit my business, or somewhere in between, right? We all fall somewhere at the end of the day. And I think that there's different opportunities. When I'm thinking about the conversation we've been having, a lot of it has been towards spending money, the conversation towards S corps, which I feel like there's so many other things that we could probably go deeper into. Like we mentioned the SEP, we mentioned the 401k, solo 401k. And I think that there's whole talk tracks there, probably not in terms of today's conversation. They feel almost standalone in terms of the size. But what about other investments we're making as business owners? We have portfolios. We have things that we're putting capital towards throughout the year, and not everything always works out. What about in those situations? Is there any way that we could harvest some losses?
Yeah. I'll give one example. There are multiple strategies applied to that. I'll give something that happened to me this year, and then I'll let Rachel and Spencer take the others. But yeah, I invest in startups. Like I invest, I put checks usually between like $10,000 to $50,000 in the small one, and if it's something bigger, usually I do it with my friend, and we are putting like $100,000 checks and more. And a lot of the time, like in this year, like we had an investments from 2022 that didn't work out. Totally fine, it happens. Like which we tell founders, by the way, it happens. It's all good. Like don't beat yourself too much for that. However, from my perspective, the moment after I had the call with the founder, I'm a client of Gelt myself, so I just like reached out to my tax lead, the person who is managing my taxes. Hey, to let you know, this investment that is already in the system, it just went to zero. It's in that case, it was basically eligible for section 1244. Basically, I was able to take the losses from that deal, let's say $10,000, as ordinary losses instead of like capital losses. So if you invested in certain startups and companies, you might be able not to take the losses just as capital gains. Maybe you do want to take it as capital gains, by the way, depending on the composition of your income. But in my case, I prefer to take it as a deduction against my ordinary income and my business income rather than as capital gains in this specific case.
Help folks at home understand the difference. So when we're saying ordinary versus capital gains, what's the impact to them? What does it mean to them? And how could they make the right type of decision there?
So you have many types of taxes. You have ordinary income that is subject on certain sources of income. It really depends on the source and how you made the money. So if you're a business owner, your income is active and ordinary because you're like it's an active income because you work towards that income. Because it's a business income, it's also like ordinary. It's going to be taxed as ordinary income, meaning all the progressive tax brackets that you know about. If you invest in an asset, usually it can be a company, it can be like a boat. Let's say that you went like whatever example we can come up with. Let's say you invest in a stock. That's usually you invest in an asset, and when you sell an asset, you have capital gains, and it's usually tend to be passive. If you invest in a rental property in real estate and you have rental income, it's its own type of income. Rental income tends to be by default passive, by the way, in most cases.
So I think like how you're taxed on things really depends on what you have and how you're using it. So you just gave a couple of different examples of like you own real estate. It could be taxed as something that's totally personal. It could be taxed as ordinary income. It could be business income. Like you own real estate, and then what you're doing with that real estate is going to drive how it's taxed. So what rate you'll pay when you make money, and what'll happen if you lose money. And there are different rules lots of rules for all different situations. So it kind of goes back to like it's personal. But I think to go back to like the different types of losses that we can have, and how you got that, like how would you get that, that 1244 loss? What was special about that investment that you made that like made it qualify?
It's basically we invested in a startup that had less than $1 million in like it was one of the very first checks in the startup. So it was a C corporation. It was very early on, not a lot of assets there. So there is section 1244 that allowed us to do that, and it really depends on the asset itself, whether you can take it or not. But that's one of the things that I can do at the end of the year. I can look at my sources of income and say, hey, do I want to have this election? Do I want to take it as ordinary losses, or do I want to take it as capital losses? And this is the kind of thing that I'm doing at the end of the year and letting the team know at the end of the year what I want to take. There are other things that you can do, and I'll let Rachel and Spencer explain about other techniques.
And that feels like the important thing right there. It's like the end of the year, right, which we are right now. It's November. We're coming up on it. Scope of webinar is how do we close out the year strong in a strategic way that reduces our exposure. And one of the things that we could stop, pause, and appreciate is the potential for harvesting any losses and looking at things that have happened and looking at things that we could potentially take action upon, or potential, I don't know if reaping is the good word to use in terms of harvesting losses. But the other thing I'm learning is 1244 is the definition of a champagne problem that we hope that all of our audience listening gets exposure to, in a good way and also a bad. So from looking at the ranking and retrieving of all of these different strategies that we've been able to get into and talk about today, first thing I think is really important is appreciation of anything we may have missed. Right. So truly giving a really deep dive inventory of these different talking points, super relevant to folks listening, because they are probably, like at the beginning, we said, take out the pen and paper. Folks are probably keeping notes. I have been. So hopefully they are as well, because this is relevant information. This is life. Life is a very real thing. Treat it accordingly, right? It's important. It matters. Take it serious. And this is a way to do so. It's a way to stay accountable and then make good, timely decisions. If we were to inventory if we're missing anything, I'm curious if there is something that we want to just plug in before we wrap up, so that we at least have a moment in time to, reference for anybody listening. They could go back and do research later if we don't get into depth, but minimally just, flag it. And then if we inventory and we say, hey, we covered it, what's the most valuable? Like, I'm curious this entire time. I've been ranking and retrieving. It's like if you were to give a suggestion of focus, because strategy equals focus sometimes, and you just need a place to start, what would be kind of like the high level mark of somebody listening at the end of this webinar? Definitely take the time to maybe take this into consideration. And then after you do, go visit joingelt.com and have a real conversation so that you can actually get something that matters in terms of a relevant thing to you. Asterisk, asterisk, asterisk. This is not personal advice. What would we say if we were to inventory it?
I think that if you ask that again, my opinion will be different than Spencer's opinion, and it will be different than Rachel's opinion. The way I think about it, the number one thing you want to think about is structure, like how the money flows, how the money flows between entities, what types of entities you have, what's the overall structure. Then you want to optimize for deductions, like what can you take as deductions from the business. So structure, the S corp is one example of a structure. Mm-hmm. There are many other potential structures. Sometimes S corps are not a great option. There are other options out there, and it's quite fun actually to choose. But structure, then expenses. What can you take that is reasonable? You need to actually need it. What you can take against that can reduce your taxable income. And then finally, whatever is left, what do you want to do with the money? How do you want to invest it? Retirement versus taxable brokerage account, etc. Those are kind of like my priorities. And if we kind of convert of what we were talking about right now, I would say like make a decision whether it's an S corp or not. Then I want to see what kind of expenses, like whether my vehicle, home office expense, whatever it is, I can take against my home. And then finally, I would look into my retirement contributions and other deductions. But that's kind of like how I would prioritize everything.
Which, listening to that, I mean, it is a flag there, because we didn't really get into the contribution aspect. We talked about harvesting briefly. We talked about some things that we can do with the S corp, but what we didn't really get into is the concept of a contribution. And I'd be remiss.
So many other things also.
There's a lot.
There is enough to talk about it for literally weeks at a time. And it's true, because there is so much that it's possible out there. The US tax code is so complicated and filled with incentives and contradiction and limitations. And what I believe what makes it so advantageous for so many Americans, and what makes it the best tax system in the Western world, by the way, in my opinion. But of course,
you said that last
I'm just
time.
like
yeah.
I'm a lowly immigrant. What my opinions matter? But that's the truth. I think that there is so much that you can do. Each person needs to educate themselves, understand their options, just be a bit more knowledgeable about it, and then choose what they want to take advantage of,
or get help
that is personal to their situation.
And honestly, I think the get help part is important. and you could get help with Gelt, which
Yeah,
which
yeah,
I
of
think is a
course.
very real thing. And honestly, it's like sometimes you just need a place to go. And for folks listening, they're living this. This is life. Depending upon where you are and who you know, life is a very real thing. Sometimes you could just go to a Google search. Sometimes you want to have like a reference to be able to go to and have a conversation of. And it feels like you guys are open to conversations, which is a really simple place for folks to start. So if they are on this webinar right now and they're watching it all the way through to this end, which I definitely want to hear everyone's roundup in terms of top three. I'm not going to let everybody skate, but if they're listening and they're here, then at least they have a place where now you can flow it.
Yeah.
Spencer, Rachel.
Yeah.
I'm not letting you go until you give your top three.
Yeah. Well, funny enough, I mean, Tall thought we'd have. I kind of agree with Tall. I definitely think structure is the most important, and I know that we kind of take a contrarian approach or a very nuanced approach to the S corp election. But if you are the type that is a good fit for the S corp, I mean, it can save you a lot of money on taxes if you are missing that very important piece. And not only the self-employment tax, but we didn't even talk about PTET to get past the SALT cap, which has changed a little bit with the big beautiful bill that came out this year, but still relevant, especially for very high earners. So structure, definitely number one. And then maybe it's the accountant in me, but I also agree that you should focus on your expenses. And there's so many people that are spending money on legitimate business purposes, and their books aren't organized properly, and so they're missing out on expenses that they should be taking against revenue. So definitely make sure you're doing that. And then my number three, just to switch it up and not go with Tall, I'm going to say the Augusta rule. If you could do the Augusta rule before the end of the year, that could have some pretty big impact as well. Talking thousands of dollars. So I like that one too. That's my number three.
Dig it. You threw some acronyms. I'm not going to hold you account to it. I'll just have everybody jot it down and do a Google search after the pod.
Yeah.
but S corp deductions and then Augusta is what.
Yeah. If you're curious about PTET, you can find me at spencer@joingelt.com, and I'd be happy to have a conversation with you.
Dig that. I appreciate that.
That's my plug.
Rachel, you're rounding us out.
All right.
Last but not least, top three of the three.
Yeah, I'm not too different. I think your structure is super important. But it's, when you're at the end of the year, I think the best thing that you can do is really understand where you're at. And then once you have a good feel for where you're at, then you can be then faced with, what are you already doing that you're not taking advantage of? So I would want to prioritize things that, I've already done it. I'm already working from my home. I'm already using my vehicle for business. I'm already doing these things and making sure that you're doing them in an optimal way where you're getting the full benefit. And then beyond that, what can you do differently to get you where you want to be? Depending where you're at, you might be in a really low tax bracket this year, and you actually want to take advantage of that and do things to make your income higher so you can have that low pay less tax than next year when you could be paying tax at 10% more. So really understanding where you're at and where you want to go. And then after you've dealt with what you're already doing, then really focus on what's most important to you. If putting money into retirement is important to you, for all of the things that we've talked about today, there are 10 more things that we haven't talked about. So if retirement's important to you, there are all different kinds of retirement plans, even cash balance plans. If charitable giving is important to you, donor advised funds, things like that. Think of if cars are really important to you, then buy a new car every year and use it for your business. So just kind of customizing what you want to happen based on the things that you like to do, because taxes are our life, but taxes shouldn't be your life. They should, make your life better.
Beautifully said.
And that's the way that that's the way that, like, you don't want to be, stuck in this heavy vehicle that you hate, because that's not worth it. You just focus on what you like, and there's a tax benefit out there that'll probably be perfect for you.
Yeah, we're big proponents of the fact that your business, you have a business to be able to support the life in which you want to enjoy, and you shouldn't be, dedicating your life or wasting your life to build the business that you don't that doesn't necessarily support what you want to enjoy. And a lot of folks are at different stages. Many folks listening may be at that side hustle that we talked about earlier. Many folks absolutely are professional service folks that are high income folks that need to definitely address this stuff. And maybe some things that we covered today are actually call to actions in terms of urgency, that the time is now. You still have time, which is what I'm taking out of this episode today as well. So take action today. This is the time to do it. Definitely do so in a good, timely manner. And I appreciate everybody investing the time today. There's hopefully some carve outs that we can. I think that the concept of investment is like such a growth mindset conversation that a lot of today has been around expenses and deductions, and the concept of potentially a carve out conversation in the future of how we can set up these retirement accounts and investment accounts and do more with the money in which we make and earn because of the value in which we create for our customers. That feels like a very prosperous conversation or fruitful conversation that we could potentially have at another time. But in terms of today, this is going to wrap it up. We wrapped it up with the top three of the three guests today. Tal, Rachel, Spencer, thank you for joining us. This has been a phenomenal Bootstrapper Live Bootcamp webinar. Hopefully everybody was able to take notes at home. And if you do have notes and you have questions, you also have a place to go. Spencer, we appreciate you for throwing it out there and making yourself available to be able to field any questions from anybody listening, as well as the ability to go to the site, which we're going to link to everything so that everybody has all of the resources that we need. And we're also going to create show notes as well. So there's write-ups and materials that folks can hopefully lean on and learn from the time that we invested in today. Appreciate it, everybody. Trust the process, commit to the journey.
Thank you. Thank you, Chris. That was great.
Thank you.